Welcome to the Property Buyer Podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies, and experience and help you achieve your property goals. Well, welcome to another edition of the Property Buyer Podcast. I'm Rich Harvey, and today we're diving into one of the most pressing questions for property buyers and investors. How will global economic shocks, especially Trump's latest tariffs moves, impact the Australian economy and the property market? To help make sense of Trumponomics, as I call it, and the new upside-down world order, we're blessed to have well-known expert, Dr. Shane Oliver, Chief Economist at AMP, who'll share his perspectives. Shane brings over 4 decades of experiences in interpreting global markets and their local impact. Shane brings clear-headed insights into what's really going on behind the headlines and what it means for your property decisions. Today, we'll explore things like inflation, interest rates, employment, and whether the Australian property market can weather yet another global storm. Welcome, Shane. Great to have you on the podcast.
Thanks, Rich. Thanks for having me back, and thanks for that kind intro.
That's all right. Well, you've been doing this for 4 decades. I can't believe you've been doing it for so long, right?
Neither can I.
Doesn't time just catch up with you?
It does, but Shane, we go through one of these crises, I'm sort of reminded of all the previous ones, stretching back to 1987.
That's right. Well, you're well versed in that. But before we get into the sort of topic of economics, I want to ask you just thoughts on a thought of the week that we have as a tradition in our podcast. And my thought of the week this week comes from Sir Klaus Moser, who said, "Education costs money, but then so does ignorance." What do you say to that?
Well, that's totally true. The cost of not having an education, obviously you do save money in the sense, but you can end up with lower income levels. You typically find in Australia that the more educated you are, the more you get paid. Doesn't always work the case. You can find lots of counter examples to that. And I think there's a broader issue that if your education has the benefit of providing a whole range of perspectives, and it reminds me of that very old Monkees song that wasn't written by them. It was probably written by Carole King and co, which is something like Shades of Grey. That when you're young, everything seems black and white. As you get older, it's all shades of grey. And education helps you see the shades of grey. There's no, for example, if you take Donald Trump, who's a bit of a topic at the moment, to my way of thinking, he sort of preys on people's ignorance and comes up with simplistic solutions, missing the shades of grey. And I think that that's a function of ignorance. If you take Ronald Reagan by comparison, he relied very much on economics and common sense. Milton Friedman was one of the best economists I've ever come across, and he implemented policies which seemed inherently consistent, whereas I think there's a degree of ignorance leading to grossly inconsistent policies in the US at present, and that's a classic example of where ignorance and a lack of education is going to cost the Americans money.
Indeed.
Ultimately.
Yeah. Well, I remember one of my university lecturers when I was doing economics at Macquarie used to say to us in the tutorials, he said, "You guys that are here in third year, you're going to earn a lot more than other people that perhaps don't have the same level of education." And that's not being just pious about education, but for me, it taught me how to think. It gave me a sense of independent research and a heck of a lot of common sense. It didn't necessarily give me all the tools and equipment I needed to run a business, but it certainly gave me an edge in terms of understanding and reading trends, like I'm sure it does for yourself. And you've mentioned, great economists like Friedman. But I think ignorance is something that unfortunately is obviously still around, and a lot of people pay a lot more cost because of that ignorance. But
It certainly is. It's unfortunate. I mean, that what your economics lecturer told you makes so much sense. And that's why when you go to university, you should pay some price for that. We've devised a fantastic system in Australia where if you go above a certain income level, you start paying some of it back. And now we've got one side of politics saying that if you vote for us, we'll wipe 20% off that. And everyone thinks, oh, great.
Free education again,
But it's ordinary workers paying for people who are going to end up earning a lot more than them. That I think is something based in ignorance, ignoring the fact that you get a university education, you'll end up getting paid more.
There you go. Well, look, let's get into the topic, Shane. I'd love to ask you just off the top, Donald Trump, he's obviously pretty dramatic with his tariff announcement, but how do you think his recent, draconian tariffs, how's that going to impact global trade and general economic growth right across the world?
Look, I think it's a major problem. I mean, this guy is wrecking a global economic system based on free trade and interactions between countries that's been in the making for 80-odd years since the end of World War II. He's wrecking it in a space of a few months.
I just find it unconscionable that someone, who's supposedly a smart businessman, just comes in and with a ridiculously Donald Duck type signature, just suddenly creates chaos right across the world. I mean,
it's ridiculous.
The fact that the bond markets reacted so strongly, I'm sure we'll get into that, but it just seems like it's having a ripple effect right across the world.
It is, and I think he's underestimated that, and he himself, I think, is starting to get a bit yippy, to borrow that phrase that he used last week in relation to why he was backtracking a little bit. People are getting yippy, and that includes him. US bond yields go up. They're going to be paying more on their budget debt, $2 trillion a year, and they're going to be paying more on their debt, which is about $35 trillion. So it's a major, major problem for the US, and he doesn't realise that if he causes a loss of confidence in the US, which is at the centre of the global financial system, that has huge negative impacts on the US. It was funny the other day, like in Australia, rough surveys show that about 20 to 30% of Americans might have voted for Donald Trump last November. 70-80% of us would have voted for the other side. As you get older, as I have found myself getting more conservative. Maybe you've got more income or more wealth to conserve. But I remember in this presentation I said, think about Ronald Reagan, one of America's best presidents at the time. I hated him because I was more left wing, and someone yells out, "Well, you still are," because I'd said some negative things about Trump. And then I think about it and I thought, well, what? You've got to be joking. Trump is not a consistent conservative. He's all over the shop. There's no consistency there whatsoever. It's not sensible economics what he's doing. It's just crazy, ripping things apart. And we will all end up paying for it. And I sort of wish for the day Ronald Reagan was still around, someone who was respectful of people, took the time to explain why he was doing things, wasn't perfect, did make mistakes and so on. But took a broom to the US economy and got it into good shape. And of course, America, and of course in Australia, we had Hawke and Keating doing something similar, although they'd never admit to it, but they were. That set us up for decades to come in terms of growth and living standards and obviously productivity. And now that's all being messed up and wrecked and trashed, sure.
Do you think it's a short-lived thing? I mean, they have 4-year political terms. Do you think this kind of, global wrecking ball approach will subside in 4 years? Or do you think it's now sort of set in motion a lot of lack of free trade for decades?
Yeah, that's the big unknown in all of this. See, on the one hand, you could argue, and I recall with Ronald Reagan that when he came in 1981, the US economy went into recession in 1982. And that was as Paul Volcker tried to squeeze inflation out of the system. But to me, that was a positive move, along with the other things that Reagan did. And ultimately, the economy, in the words of Ronald Reagan at the time, began to sparkle. And he benefited right through the rest of the 80s. And Clinton also benefited from that. So you could argue there's some logic to this. Get it over with early, do the detox, pull the Band-Aid off, create chaos, and then you pivot to more positive policies. But then you don't quite know with Trump because he is causing so much damage here in terms of free trade. And whether it's, the US economy goes in recession, then he pivots towards tax cuts and deregulation, more positive things, and then it turns out okay. That's possible, but then he's also said that he wants production to come back to the US, that it's not just about escalating to de-escalate. There is a desire here to go back to the golden age, the 1950s.
But this is the point, Shane. I've seen some pretty funny memes on social media showing all these American workers sitting in sweatshops. They're producing T-shirts.
Some of them include J.D. Vance and Musk and Trump. Assembling Nikes or something.
Exactly. I mean, but it's the whole idea of free trade is in terms of countries are better at producing goods than other goods. I mean, Australia's a great exporter of education. Obviously we're great in commodities. Taiwan was fantastic in electronics for a time. So each country has its own unique specialisation and done at a very reasonable cost. Is it realistic to think that American manufacturing will be revived? Honestly, I don't see that happening.
I think it's fanciful for lots of reasons. One is it will take years to bring production back to the US fully. I know Trump keeps parroting these billions of dollars being invested here, there, but that's US companies trying to butter him up. Impress him or something. They don't know how to do that. But the reality is it will take years to bring auto production back from Mexico and Canada and everywhere else that it is. Then there's the question of, companies will think to themselves, well, a lot of these things will be challenged in courts. What about the next election? Will Trump still be around? Many of the policies might be reversed. Maybe it's not worth doing. In any case, maybe we should still leave it in Mexico or China or wherever, because it's still cheaper than producing it back here in the US, because labour costs in the US are 5 times what they are in Mexico and China and elsewhere. So all sorts of question marks around that. Then there's the question, when you ask Americans where do they want to work, kids or older people don't want to work on production lines. Maybe I remember in the 70s, I'd watched Laverne and Shirley, and they're working in the bottle, assembling bottle caps on soft drinks or something. And that was a sort of a hankering back for the 1950s and early 60s, the simplicity of that time. But people don't really want to do that anymore, work in factories. If factory jobs do come back, I suspect they're with robots anyway. So I don't think it's going to happen.
No.
I think you've got to move on. It's a bit like when we moved in the industrial age, people hankered to go back to the agricultural age when everyone worked on a farm. But that was impossible, and no one really wanted to do the backbreaking work of working on farms. And it's the same with factories. So I think it's just a pipe dream.
So if we accept that this is a fanciful dream and it's going to cause chaos, obviously it's going to create inflation. In what ways do you think these tariffs are going to create inflation both internationally and within Australia?
Well, I'll give you an example, which of course gets wrecked fairly quickly because Trump changed his mind and moved in a different direction. But if you take the Apple iPhone, currently retails in the US for $1,100 US. About half of that, just over half of that, is the imported price. Most of them are assembled in China. $580, I think it is. If you apply the 145% tariff to that, and Apple maintains its margin, then the price of that Apple iPhone imported from China goes from $1,100 to $1,800. Now, of course, it's not going to happen that simply. Apple will have to absorb some of the margin, some of that on its margin, but there'll still be a price rise, even if Apple switches production to other countries, which will take time. They'll face tariffs as well from those other countries. So you get a hit both to the company, Apple's margin, and you get a hit to US consumers. Now, of course, since then, I think Trump realised, well, that's a crazy thing, so he issued the Trade Department in the US issued a
reprieve,
a qualification saying, oh, well, that iPhones and smartphones and computers won't be subject to this tariff. Then a little bit later, on Sunday, they're saying, well, that they will be eventually, but not at the moment. We're going to put our own tariffs on them. So whatever it is, it adds to the cost. If you try and produce that iPhone in the US, just say, with US wages 5 times what they are in China, the price goes to $2,500. Again, a hit to Apple margins because that price won't be bearable, and a hit to consumers and some mix of both of them probably. So that has a huge disruptive effect. I mean, that's an extreme example, but there'll be lots of other examples where companies will either have to pay a higher price, eats into their profitability, that puts up prices in the US, so that's where you get the inflationary component. But it disrupts supply chains, it creates uncertainty, so businesses which were planning to invest think, oh, maybe we won't, we'll just wait and see.
What's going to be the employment consequence of all of this, on job?
I mean, this is how bonkers it is. The US economy was running basically at full employment. They've got an unemployment rate of around 4%, just above 4%. That's how it left. It was actually quite a strong economy. And some people said it was the world's locomotive. It was growing over 2% last year. Europe and Japan and what have you were less than 2%, more like less than 1%, and in and out of recession. So it was helping keep the global economy afloat. It was actually quite strong. And so this idea that we've got lots of workers around anyway who could go and work in factories in the US was pure nonsense in the first place. But the odds are that now with consumers feeling more cautious, we have seen a sharp fall in consumer confidence in the US and business confidence, with consumers spending less and businesses investing less, that this will result in higher unemployment and it runs the risk of recession in the US. I don't think it's a dead cert that we'll go into recession in the US. I know some have been saying we will. I think it's close to 50-50, but whatever it is, you're going to end up with US growth a lot lower than it previously was thought to be. And that is where... That's why in Australia we're worried about it, because the world's biggest economy slows down, flow on to China. Those two are at a battle to the end sort of thing. Other countries get affected as well. Confidence effects. This issue is getting blanket coverage in Australia, and that affects confidence.
So just about exports, like Australia, we export around 4% of our products to the US. I mean, how significant are these tariffs directly on the Australian economy, do you think, on our exporters?
Not very. And this is where I don't want to get too negative here, because Australia is in a better position. There is precedence for this. The old story was US catches the cold, we get the flu. Think of the early 80s and early 90s recessions. But since then, that hasn't applied. We sort of sailed through the tech wreck. We only had 1 quarter of negative growth and no recession at the time of the GFC. Lots of factors in there, but we have proved more resilient in recent times. And so to put all this in context, as you say, US exports to the US are only a small part of our total exports, less than 5%. That's about $24 billion. About $4 billion of that is gold. That gold can go somewhere else. We don't have to sell it to them if they don't want it. I think they'll still want gold though. But and a lot of our other stuff is agricultural products, which can go to other markets as well in time. There's talk that if China is not getting beef from the US, then maybe our beef will go there. So you got about $24 billion or $20 billion if you exclude gold. That is, as you say, around 4% of our exports or less. It's less than 1% of our economy, but most of those exports will still occur. Go to the US or somewhere else. They may be less competitive in America than they used to be because of the tariffs, but the exports per se are not being blocked. Unlike the $20 billion in exports that we
But I think you mentioned a really critical point, though. You mentioned China in that last comment, and I think it's the impact on China, because what percentage of our exports go to China? It's a much larger percentage,
right?
35%. 35. So if China really slows down, then that has a dramatic impact on Australia, right?
Yeah, that's the risk. This is where the key impact will come. If you're in those industries like steel and aluminium, or soon to be tariff pharmaceuticals, not there yet, but I reckon they will with Trump, and other industries, that's bad news. But it's a small part of our economy, and the exports will probably still flow anyway. So I don't see a big hit there. The main blow is psychological, that a friend has done this to us, sort of thing. The bigger impact is if the global economy, particularly China, goes into recession or slows down. That means less demand for our exports. So that's the big worry there. But there again, there are some offsets. China, like I suspect, it's not all of China's exports that will be hit here. It's only the was it 15% or something or other that go to the US. the exports to the rest of the world are not being affected. So America is in a trade war with everybody. Everybody is only in a trade war with 20% of the world. So in the US, they're in a trade war with all of the world, the other 80%. The other 80% are only in a trade war with the US. So they're not. So the rest of the world is not as badly affected as the US.
I was hearing about the growth rate of China. You mentioned the growth rate of the US being 2%, but China was, back in the day doing 8-9% growth per annum. It's phenomenal. I think it's slowed down to like 5% now. Well, what do you predict the growth rate, economic growth rate will be of China under this sort of new cloud?
It'll probably be closer to 4%, maybe above that, but closer to 4%. So you get a hit from, a big disruption to exports flowing to the US. That can't be fully made up. Against that, though, and this is why I'm not overly negative on China, China has lots of potential to provide support to their economy, and they have committed to supporting growth at around the 5% level. So they'll pump in stimulus to help Chinese consumers and limit the slowdown, I think, somewhere above 4%. So, yes, slower growth there, but I don't think they slide into recession.
Yeah, cool.
Go negative like they did at the time of the pandemic.
We really appreciate you tuning in to the Property Buyer Podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word-of-mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues, and ask them to subscribe to the Property Buyer Podcast. It would be a big help, and we'd be very grateful for your support. Thanks once again for sharing the links. And now, let's get back to the podcast.
Shane, I want to ask you about our own economy, particularly the Reserve Bank's response to all of this. And there's lots of speculations the RBA is going to dramatically cut rates. What are your insights on this possibility? Do you think we're going to see 3 rate cuts like some of the financial markets are predicting from May this year?
Well, we could. When I last looked, the money market was talking maybe 4 or 5 by the end of the year, and that's 4 or 5.25% cuts. So we're currently 4.1. If we get 5, then we go to 2.85% on the cash rate. So this is the silver lining on the Trump cloud, if you like.
Yeah.
There is another one. Oil prices have fallen, and so petrol prices might end up settling at a level which is about 10 cents a litre less than prior to all this. But the interest rate story is the big one for many households, obviously, with a mortgage and home buyers. I don't think there's a need for an emergency meeting. I think that would just panic people. I know people were talking about an emergency meeting last week.
Yeah.
You do that when it's clear that your economy is going to take a massive hit and your markets are not functioning well. But the lending markets in Australia are still functioning well. If banks want to borrow money in the short-term money market, there's been no disruption there. Yes, bond yields went down, then they went up again, but the Reserve Bank's not going to be too focused on that. Interest rates move around all the time. So I think an emergency meeting is unlikely unless things get a lot worse from here. It's a possibility, but as we get closer to May, they'll think, well, we've got a meeting coming up, so we'll wait to then anyway. Our view before this was that they would cut by 0.25% in May. That remains our base case, but there is now probably a 35-40% chance that it could be 50. And then we'll probably get another maybe 2 or 3 by year end in terms of cuts. So that is the silver lining for those with a mortgage or prospective borrowers. On the one hand, we know from things like this, the GFC is a lot different. Banks today are a lot stronger, better capitalised than they were then. You don't have issues in the US property banking system that you had now. There are issues, though, as Warren Buffett said, when the tide goes out, you get to see who's swimming naked. So problems could be unearthed. So there's potential issues there. But I think, great scheme of things, it's not the same as the GFC. But just if you think back to that period at the latter months of 2008, around October, November, the property market in Australia dried up to some degree. I don't know what your experience was, but I used to count the number of houses from my house to the roundabout I live in Avalon, to the roundabout. They call it Kamikaze Corner, Begolla Bends in Sydney's on the beaches. And at one point there, I noticed I think it was about 18 houses for sale with for sale signs. There's normally, like, go along that road now, there'd be about 2 or 3 at any point in time. So it shot up as a lot of small business people, found buyers sort of stopped buying at their shops or wherever and their businesses, and they had to list their property, and buyer demand also fell, and you got this sort of mini dip in property prices. Obviously, that situation was a lot more severe. Share markets were down 50% at that point. So far, they're down a lot less than that. But so you can have that sort of effect where initially you get this bad news, the headlines are all negative. Is there going to be a recession? Buyer inquiries slow down and so on. Then what happened was the RBA started to cut interest rates, first in September 2008, then progressively through the rest of the year with 100 basis point moves down, continuing into early 2009. Property prices then bottomed and picked up again, and we had a good run into 2010, I think it was.
Really good run. I remember that year very distinctly, Shane. I remember I wasn't panicking in terms of my business, but certainly demand for buyers agency services certainly slowed down. But my message I was trying to get out there, much what I'm trying to do again with yourself in this podcast, is to talk about how low rates are an absolute massive stimulus for the property market. And I remember in 2008, there just lack of competition. It was a fantastic time to buy, and I ended up buying 3 properties that year to add to my portfolio, and I've still got all of them today, and they're great buys. So I think your point is we get all these crazy headlines and everyone panics and adopts an attitude of uncertainty. But as you talk about silver linings, the silver lining is, mortgage rates are coming down. We're not building enough properties. But I'm curious to hear what your response or your thoughts on where you think this will lead the housing market in terms of demand and prices over the next 5 years.
Well, that's a good point. If rates come down, then that obviously spurs on more demand. And then, of course, we've got in the last few days, in the run-up to the election, a lot of policies from both sides designed to boost or enable more first-home buyers to get into the property market, which has a sort of an effect through the chain. You've got more first-home buyers getting in with lower deposits under Labor or the home equity scheme, shared equity scheme they're talking about, or under the coalition with tax deductibility up to $650,000 mortgage over 5 years, $11,000 over 5 years. Whatever it is, this gives people more buying power. That adds to demand. I mean, I'm still a bit sceptical about whether supply will deliver. It's still constrained. I think the government come with a target, 1.2 million homes over 5 years, to 40,000 over a year. So far, we're almost through the first year, and they've only built, we're only on track for about 180,000 housing starts if we're lucky. So there are some positive signs there that supply might pick up. Building approvals have been improving lately, but we're still running below the levels we need to, and there's an ongoing housing shortage of Australia of between 200 and 300,000 dwellings, depending on how you measure it. So that supply imbalance will remain for some time to come. And so if you lower interest rates and you give lots of handouts to people or make it easier for them to get in the property market, then it spurs demand again. So, yes, we might have a bit of a dip in the short term. I'm not totally convinced they'll come down as much. This is not the GFC, but it might cool off for a bit. Then you get the rate cuts, and then we pick up again. So it's, as they say in all assets, the time to buy is, when markets are weaker and there's less buyers around, less competition. Time to sell is always at the top. Best thing to do, of course, is take a longer-term approach if you can, which you've done with your properties you bought back in 2008. But, I do worry about that it's not the Reserve Bank's job to worry about housing affordability. That's more the role of the government.
No,
so
that's right.
People naturally blame them for cutting interest rates and then giving us expensive housing. I think that's fallacious. The alternative would be if they didn't cut how would we feel then if we go into recession?
Well, I think it's to do with a lot of confidence. I think it's investors and home buyers, they really, take a lot of action based on how they feel. We look at the consumer confidence rate numbers that come out each month, right, through the Westpac Melbourne Institute survey. And it's interesting to track that number. It was sitting at around 84 points for many, many years, and it's sort of tracked up to around 94, 95 points. It's not quite back to even confidence yet, but that investor confidence is really critical, I think, for particularly the property market. But I'm curious to ask you, I guess, what strategies you think property investors might think about or employ to mitigate the risks associated with all this trade uncertainty. I mean, a lot of investors are doing nothing in the face of uncertainty, but do you think doing nothing is a smart strategy or a costly strategy if we're looking, to the future over the next 10 years?
A lot of the time, providing they had the right strategy in the first place, a lot of the time it is the right thing to do nothing, because if you panic, you often end up making poor decisions. Panic in the sense of, I'm going to sell now, or cease any. If I was going to buy something, I won't buy it. I think the best thing to do is avoid panic decisions. If prices do come down and you find opportunities out there, now's the time to be looking around. I must admit, prior to all this trade stuff, I was thinking we'd seen the bottom in prices in East Coast cities, and that now with rate cuts on the way, we'd see a gradual recovery. This tariff shock is sort of thrown a bit of a spanner in the works potentially. But I, with all of these things, I think they provide opportunities for investors. So doing nothing is one option if you're already in there. I don't think it makes any sense to panic out. By the time you get out, you might find yourself selling at the bottom. You've got to think about whether you get back in again. But alternatively, if you are thinking about getting in, then now's a time when buyers are uncertain, and the anecdotes I hear is that buyer demand has cooled off. And that uncertainty could get worse from here before it gets better, because the tariff story hasn't ended yet. And therefore, you're better off continuing to look around. And the good news is you're probably going to find less competition out there. You might pick up bargains that you otherwise thought you couldn't, or you worry that you missed out on. And then I think we'll almost certainly get interest rate cuts, which then provide a cushion for the property market as we go into the next year or so.
I find a lot of investors are very slow to read the tea leaves, as I call it. Like we hear talk about rate cuts, and I think you and I know there will be rate cuts, but a lot of people don't take action until the cut has actually hit their wallet, hit their bank account, and then they feel comfortable to make a decision. A lot of people want all the ducks to be lined up in a row before they want everything done, and they won't leave the shore until it's perfect sailing conditions. But I sort of just want to go back one step. You did touch on it before, talk about market resilience and just how, I'd like to ask you, how resilient do you think the Australian property's been in the face of all these GFCs and other types of shocks over the last 20, 30 years? Because in my mind, it's been a very stable, bedrock of wealth. Obviously we had COVID where prices went crazy and then corrected a bit naturally. But what's your view on the resilience going forward of the Australian property market?
I think it's another shock that might test it, but ultimately it will prove pretty resilient. It is quite normal for us as humans to be somewhat backward looking. That's why you wait for all the ducks to line up. Unfortunately, that's what many people end up selling at the bottom and buying at the top, rather than anticipating. Warren Buffett is a classic example of someone who doesn't rely on forecasts or anything. He just says, when things collapse, that's a good buying opportunity. When things are too high, maybe that's an opportunity to sell to lighten off. But he takes a very long-term horizon, and that's what most should do in all of this. I think if you go back over the last few years, the big surprise for me has been just how resilient it's been. I remember 20 years ago thinking this is way over the top as property prices first started to break above levels which were seen as normal in terms of the price to income ratio. For many years we had average house prices in Australia trading around or about 4 times average annual earnings, wages, and then suddenly it started to break out of that as we went into the 2000s. And then, of course, we heard report after report saying, there's excessive mortgage stress, property's going to crash. And, of course, lots of events have come along, including the GFC, where it didn't collapse. And that's partly because governments jump in and provide support. That's what happened at the time of the pandemic. This is the sort of scenario with surging unemployment and long queues at Centrelink. This is the sort of environment where things could come down rapidly. We could have a 20% fall, but I was wrong, because what happens is that the government sees those same forecasts. They go to the Treasury. What could happen if we don't do anything? Prices could fall 20% or something like that. Oh, well, we can't let that chaotic environment happen. It's not so much to protect property prices. It's not their main thing. The main thing is to protect unemployment and the broader economy. So therefore, they have to jump in with things like JobKeeper rather at the time, and lots of interest rate cuts. So, but the other aspect is that I think in Australia we've underestimated the chronic shortage of property in Australia.
Correct.
And we continue to have high levels of immigration, and probably will, despite current talk of cutting it back a bit. Secondly, there's the issues in the building sector itself. We keep imposing more and more regulation, which makes it harder and harder for builders to put up their properties, takes longer and longer to get approvals, and time to build blows out from 1 year to 2 years or whatever it is. Those things are chronic. The other thing that I think many have underestimated is the ability of the household sector to keep servicing their mortgage. We used to say, anything above 30% of your mortgage devoted to interest payments, that must be a severe problem. Mortgage stress, worry about those people going bust and what have you, and defaulting on their loans. That doesn't happen because they have flexibility to make cutbacks elsewhere. And as wealth levels go up, as income levels go up, I think people have then decided, I can accept a higher share of my income devoted to servicing the house than was previously the case. And in any case, you look at houses being built today, compared to just 30 years ago. We've been in the same street for a long time, and I remember the houses being built when we moved here. What you're seeing today is far more substantial, more solid. Pole houses used to be popular back in the 90s, either treated pine or steel, some concrete piers, then up goes your house in a short period of time. That sort of stuff is done less and less these days. People are devoting more money to the quality of the stuff they have in their house in terms of the number of rooms and what have you. But it's all led to a situation of relative resilience. Yes, we have pullbacks. Yes, there is still a cycle, and there always will be, by the way. But the forecast for 20% falls end up going awry. End up being wrong.
Exactly.
The authorities jump in with
that's it. Rates. So the government really did put a bit of a flaw with, like you say, to protect employment. But you mentioned a good point there about house to income ratios, and obviously that's been going up and up over the decade. I think Sydney's probably around 9 times on average income to buy a median house price of 1.65 in Sydney. But what do you think are people going to get used to the new normal, and are we still going to see house to income ratio prices increasing to like 15 times income? And is the bank of mum and dad going to be needed more and more and more? Where do you see this going?
I think there has to be a limit on it. You can't keep going up forever. I mean, trees don't grow to the sky, so I think there's always going to be some limit there. I don't know where it is. I suspect that the long-term decline in interest rates that we saw from the 1980s to recently has probably hit the bottom, and that provides a bit of a flaw because you can't keep borrowing higher and higher amounts for given levels of income. So that puts a bit of a roof on it. That said, I don't think those price to income ratios are going to come down dramatically. I don't see enough in the way of supply increasing. Or interest rates themselves going up.
I mean, I see them going up. I see them going up a bit more. I'm not sure what they are in Japan, but I see the intergenerational wealth transfer event happening, particularly with baby boomers who've, had a pretty good run, and they've generated a fair bit of equity, and they'll be handing that over to their kids, or even as living wills or living inheritances. And I think that's going to have a dramatic impact on the property market.
You can't rule that out, and I think I thought you were going to mention there that if you go to some countries where cities are seen as international, Hong Kong is an example, and Los Angeles, New York, and others, you can see higher price to income ratios than you see Australian cities like Sydney and Melbourne. The other aspect is that unless we change the way we live, I kind of think, well, we should be diversifying away or decentralising away from our big cities. And that would take some pressure off, but I don't see much evidence of that occurring.
No, it's all talked about as a nicer policy idea, but it doesn't happen,
It doesn't happen. We had an opportunity there with work from home, but then seen government and business then sort of tried to get everyone back in the office again as far as possible. So that sort of halted that a little bit. I mean, the regional property is still undervalued, I think, in Australia relative to capital cities, but the catch-up sort of slowed.
Yeah, that's right. Yeah. Shane, I just want to ask you one more question about economic growth outlook, particularly for Australia. Where do you think the Australian GDP growth rate is going to end up this year and the next couple of years in the face of all these recent challenges? Do you think it's going to be thrown completely off course, or do you think we're going to be okay in terms of our growth rate?
Look, in the great scheme of things, I think it's okay. We do a lot of complaining about Australia, but in the great scheme of things, we are pretty well governed compared to other countries. I mean, I would like to see more in the election to stimulate productivity growth. I'm still hanking around for the days of Reagan and Keating and Howard and Costello. And that means tax reform, fixing up our stupid tax system, reliance on GST, less reliance on income tax, get rid of stamp duty, blah, 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 and deregulation. I want to see more of that as well. But it's hard to see a lot of that coming out of the elections.
We always live as economists. We always live in hope for productivity and revised tax incentives, don't we? But maybe one day when we get 5 to 10 year political terms, it might happen. So.
Maybe but not right now. But in terms of the answer in the short term, we were looking at growth this year picking up from around 1.3% last year to around 2.5% maybe.
Okay.
The trade thing slows that down a little bit. Maybe keeps economic growth stuck around 1.5% or thereabouts, so not as strong as it could have been. But by the same token, we are going to see lower interest rates. Both sides of politics are talking about some sort of tax cuts kicking in next financial year, $1,200 Lamito, low and middle income tax offset for under coalition $1,000 deduction, and the milkshake and a sandwich tax cuts. So, those things, and the Aussie dollar is going to be lower than what otherwise has been the case. These sort of things do provide stimulus, and I think at some point as we go through next year, you will see that pick up in growth to around 2.5%.
Okay.
But unfortunately, we're not going to. I don't think we're going to see it sort of get back into the. We should ideally be aiming for 3% plus growth in Australia. That's what we used to see as the norm in the absence of productivity enhancing reforms. Yes, we economists sound like a broken record, and that's probably not going to happen, but by the same token, it's still going to be okay.
You mentioned just the Aussie dollar declining. What impact do you think these whole trade wars are going to have on the dollar, and particularly then the property market? Because I often see for people living in Singapore or the US, and they got such great buying power when they bring their dollar back to Australia. Do you think that's going to have a positive impact on particularly expats returning back to Australia, for example?
When they look at Australia, they think it's cheap because the level of the Aussie dollar. It's a bit confusing which way the Aussie dollar goes. On the one hand, the US dollar is under downwards pressure because investors are losing faith in the US. And depending on which week you look at it, that has been dominating and keeping the Aussie dollar up. That's what happened in the last week, for example. But in the previous week, the Aussie dollar fell as share markets plunged and it hit a 5-year low, which is the normal thing to happen. So I think it's fairly ambiguous. I mean, if I was going to come up with a number, I'd say we'd probably end up stuck around 60 cents for a while, which, as you say, does make Australia look quite attractive for foreign investors, particularly those in places like Singapore, China, and elsewhere. Well, foreign buyers, call them foreign buyers, and likewise for those coming out of the US. You can imagine people in the US saying, we don't want to be there anymore, we'll come to a decent place like Australia. The US dollar is still buying quite nicely in Australia, even though it has come under some pressure.
Shane, I've got just 2 more questions for you. In terms of our trade relations with the rest of the world, how do you think Australia should approach those relationships moving forward so as to reduce vulnerability to all of these external shocks?
Well, I think the first thing to do is not negotiate with Trump. I think just insist on exemptions. He's going to ask for stupid stuff like getting rid of our GST or biosecurity laws. Yeah, fair enough. If our biosecurity laws are too onerous, then yes, we should review them. But yeah, that's questionable. Or our pharmaceutical benefit scheme. I mean, that's a good scheme. So I think there's things that we shouldn't negotiate on, and we shouldn't make the first move. We should, and given we're not overly vulnerable to it, as only 4% of our exports go to the US, a better approach would be to get together with other countries all around the world and make sure we have free trade deals with them.
Exactly.
And stick together with these other countries. And Trump will get nervous and blow himself up.
Exactly.
That's the problem. So I think the key is, continue to focus on getting better deals with other countries, and that will help see us through this.
And final question, just back to the property market, just thinking about any home buyer or property investor that might be listening to this podcast, is there any other advice or comfort you could perhaps give them thinking about how the economy and the property market might land in the next 1 to 2 years?
Well, the only thing I would say is to just look at history. The property market goes through various shocks. Obviously, the GFC was a big international one out of the US. Maybe not. We're starting to see a similar one coming out of the US. But also just bear in mind that ultimately we're going to see lower interest rates given the ongoing shortage of property. That will probably start to push prices up again at some point. So it's always a case of looking for the opportunities that these sorts of events throw up. It's the same for a share market investor, exactly the same thing. Don't panic. Look for the opportunities.
Shane Oliver, Chief Economist at AMP, thank you so much for joining us on the Property Buyer Podcast. It's been an absolute pleasure to hear your thoughts and insights. Really appreciate it, Shane.
Thanks, Rich.
Thanks for being with us on another Property Buyer Podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry, and we'd be delighted to help. Please visit our website at propertybuyer.com.au, where you can stay updated with all my latest market updates, weekly blogs and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Property Buyer Podcast.